Better System Trader, episode 76.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, it's Andrew Swanscott here, and welcome to another episode of the Better System Trader podcast. Thanks for joining us. As traders, we can sometimes get tempted into making things more complicated than they need to be. Sound familiar? Entries, exits, position sizing, trade management. There are a number of aspects to trading where we get to decide how simple or complicated we really want to make it. Our guest for this episode, LarryTentarelli, has developed a simple, no-nonsense approach to trading, and in our chat today he shares his trading insights and the approaches he's developed over the past 20 years. In this episode, Larry shares with us simple techniques to trading and trade management that he's used to turn his trading consistently profitable. We also hear how traders can overcome the challenges of finding a trading style to suit their personality. Larry shares with us the 4 legs of a table approach to trading and why it's so important for trading success, and also why there is no perfect entry signal and the key aspect of trading you should focus on instead. Plus, we have a load of listener questions that have been submitted by you, so let's get straight to it in this chat with Larry. Hope you enjoy it. Hi Larry, thanks for joining us today. It's really great to have you on the show with us.
Andrew, thank you for having me.
Now, how about we start with a little bit of background on yourself? Can you share with us how you first got started in trading?
Sure. I've been trading for about 20 years. I actually grew up in the stock brokerage business. My family was involved. So at about 7 years old, I started going to the stock brokerage firm after school sometimes. And I think that's when I first got fascinated with what was going on. I wasn't sure what was going on, but it looked like the guys were making a lot of money. They had nice cars. But I started on my own trading in about 1998. So my mentor, one of my family members, he was in the business for about 45 years. So he and I used to talk. So I was always fascinated with it. And then once I had enough of my own money put together, I figured that I wanted to get started. So what I did was I think I did what everyone does. I started to read everything I could I started, believe it or not, with fundamental analysis. So, basically Warren Buffett and Peter Lynch and, things like that, and just looking for the fundamentals of the company. And eventually I learned to go more towards technical analysis. I tend to be more of a black and white person myself. Mm-hmm. And I really got fascinated with technical analysis and charts. And I think Jack Schwager had a book on technical analysis that first got me into it.
Right. Okay. So was that book the catalyst that kind of changed your direction, or was there other inputs into that approach?
It was primarily that, and I started with Investors Business Daily. So I picked up the Investors Business Daily, and I really liked the stocks that they had, and all the charts were looked great. But the thing is, I really had no idea what I was doing for about the first 10 years. So basically, I was just a conglomeration of different types of styles and time frames. And, over the first 10 years was pretty difficult for me. I'd have some winning trades, but for the most part, the first 10 years was much more of a developmental phase.
Yeah. Okay. So if we just fast forward now to today, can you tell us a little bit about your trading style and the time frames and the markets that you trade now?
Yeah, my trading style is extremely simple. You and I met each other through Twitter, and basically, the way that I post on Twitter, I follow some very basic trend following and momentum based programs. I don't use any fundamental analysis whatsoever. I do not use traditional technical analysis either. So I don't use chart formations, Elliott wave, anything like that. Basically, I follow a trend following approach, which is reactive technical analysis. So I wait until the price actually does something before I take a position. But my trading is much longer term in nature. It's not uncommon for me to be in a winning position for, a year or 2 years.
So how did you actually come about deciding that trend following was for you? Like, what was the process there that led you into that particular style?
It was a long process. So I had lost money for a while, and then at some point I picked up Jesse Livermore's book, Reminiscences of a Stock Operator, and up until that point I was fairly confused about what I was doing, and because I would watch TV and I thought that everyone had to have a short-term time frame or be a day trader, which I was not good at. And when I read Livermore's book, the key thing that stuck out was he said that the real money in the market was made by not trying to jump in and catch every single move, but try to catch the key move. So at least that gave me some consolation that maybe, I could have a chance because I was not good as a short-term trader. It just wasn't for me. And then I read Michael Covell's book, Trend Following, which was the first book really that I read that said that, you could trade markets successfully and that there were hedge fund managers that traded with no fundamental analysis, no prediction whatsoever. So that started me on a systematic route. I started to do some back testing. I bought some back testing software. I read Van Tharp. And then I came up with my first systematic program, which was basically just a 120 moving average crossover. So I would get long on the crossover, and I would exit on the cross beneath it. And that was the first system that I traded, which was back in 2007. And from there, I just started to, go further into a systematic process.
Okay, so you mentioned there that you're doing a moving average crossover. You started doing a moving average crossover.
Right.
How has that strategy now developed over time? Because I think you said that was like 10 years ago, right? So
yeah, I stopped using the crossover because what I found was the crossover was a little bit lagging on the exit. And the primary, I trade 3 systems right now. The primary system that I trade is based around the 50-day and the 200-day moving average. It's not. The entry signals themselves aren't very complicated, but where I think the money comes from is that I address all aspects of the trade. So the entry signal, my belief, and I read this in Van Tharp's book, I think the entry signal is maybe 10% of the equation. I think, and I read Tom Basso's experiment where they used a random entry, a coin flip entry method, and they were profitable using correct position sizing and correct money management. So what at that point, because I spent, maybe half a year of my life back testing and trying to find the perfect entry signal because I was convinced that there was a perfect entry signal. And all I had to do was, once I figured it out, that would be the key to riches. And, after a while and after doing some studying, I figured out that the entry signal really wasn't where the money came from, but it came more from my approach to the market, from trading a program that was conducive to my personality, because I am a longer term trader by nature. And, I don't like to trade for the sake of trading. I do like to make money. And what I really focus on now, what's helped me out quite a bit over the years, is to learn how to undertrade, to get my position sizing in line, and to set my accounts up in such a way so that I had my risk controls in place so that I really got detached from any single one of my trades.
Yeah, I think your story there is a very similar kind of story for a lot of traders where you try lots of different approaches to try and figure out what really suits your personality. And you made a very good point there, I think, is one of the keys to trading is that you do have to actually find some particular style that suits you. So, which can be a challenge as well. So what can traders do to try and determine the particular style of trading that suits them, other than trying everything to see what sticks? Is there anything that can help traders to kind of guide them in the right direction?
Yeah, and that's that's like the $64,000 question.
Yeah.
That's a very important question. And I think, most good traders that I know have suffered either some big losses or they blew out at some point. And you're really, I don't know if there's any better teacher than experience. And, and there's dozens of ways to make money in the market. I've got friends that are good day traders. I've got friends that are good swing traders. I've got friends that trade counter trends. So, I have respect for all of those different styles. But for me, my strategy works best for me. And I think it's really just a personal thing. I have some friends that do like to sit in front of the screen for 8 hours a day. They're very good at it. They make a lot of money at it. But that's really, I think that each person has to figure out, who they are, how much involvement do they want to have in their trading, and what are they looking to get out of it. And for me, it was definitely, a much longer term. And keep in mind, you can make a lot of money over the longer term. And what I'm looking to do is I'm looking to trade less and make more.
Yeah. Yeah. Now, if we can just jump back a little bit to your approach, I think you mentioned that you've got 3 programs. Can you tell us a little bit more about those programs, just so that we can get a better idea of the type of trading that you do?
Yeah, and the entries are pretty simple. So the first one is just a daily close over the 200-day moving average. I don't really need any other indicators. I just need the price over the 200-day. The second program that I trade, which used to be my number one program, was simply a breakout to a new 52-week high. And both of these are very easy to scan for. Any basic scanning software will catch these two. I recently implemented a rule of market cap and daily volume. So what I'm trying to do is reduce the amount of information that has to get processed. So I just recently introduced, I've got a market cap limit of $2 billion, an average daily volume of 1 million shares. And as of right now, that gives me about 895 stocks to choose from, which is significantly more, than I'd ever need. On the U.S. market, there's over 7,000 stocks. There's over 1,800 ETFs. And what I found, I talked to a lot of traders all over the world through, primarily through Twitter, and I've got some, friendships offline. But what I found is that most people struggle with over trading. And I know that over trading was the thing that set me back the most my first 10 years. And over trading, it comes in a lot of different ways. It's trading too frequently, trading too many positions, positions that are too big, trying to trade too many different systems at once. So what I do for my 3 different programs that I trade is I have 3 different accounts. So in my 200-day strategy, I've got an account that only has those positions. And then in my 52-week breakout strategy, I have an account that only has those positions. And then the third account that I trade is a bit shorter term in nature. Shorter term for me is, maybe 60 to 90 days. And it's solely based on momentum and moving averages. So what I do is I look for an oversold pullback into a rising key long-term moving average, say the 50, the 100, or the 200-day. So if I use a momentum filter. So if I get a price pullback right into that moving average and I get an oversold momentum reading, then I'll take that trade.
Mm. But it sounds like with those entry conditions, it's quite possible that you could have 3 positions in the same stock, right? So how do you manage that? Do you take that into account when you're looking at potential trades?
No, because they're all in different accounts. So each account operates independently of the other one. So the fact that because I could have a trade in one account based on it crossing over the 200-day moving average, say 6 months ago, and then I could take the same trade in my shorter term account because it's pulled into the 50-day on an oversold pullback. I mean, there's been times like this year I was on both sides of the bond market. So I was long bonds in one account and I was short bonds in the other account. So each account operates independent of the other, and I don't look at that.
Yeah. Okay. Now, you made a statement earlier about the importance of entries in a trading strategy. So, how did you actually come up with those, or how did you settle on those 3 particular techniques for the entries in those programs?
Well, here's what I would say. I do think that entries are important. Obviously, because I spend a lot of time coming up with the 200-day moving average and the the momentum strategy that I use with the pullback to the rising moving average. So the entry, I think, is important, but I think traders put way too much emphasis on only the entries. And I would look at trading as, say, the four legs of a table. So, entries would be one, exits would be one, position sizing would be one, and the proper psychology would be one. So if you have four legs on a table and you knock off any one leg, the table still isn't going to work. But there's still, four legs to the table. So entries, I think, are important. I would not use a coin flip method myself, because while the system was profitable, I don't think it was extremely profitable from some digging that I've done into it. But the other thing is as a trend follower and as a momentum based trader, I absolutely do want to have positions that are in uptrends. So, I'm not going to buy into a downtrend. Even when I buy that bounce into the moving average, I want to see it actually bounce first before I take the trade. So entries, I would say entries are 25%. They're one of the four legs on the table. But if you don't have the other three ingredients, it's not going to work out. And most traders, they focus on entries and charts and setups and indicators, and they don't pay any other attention to the things that can make you lose money. And my opinion, and I've posted this before, it's really not hard to find winners. You can run a scan for new highs, or the advanced decline line on the New York Stock Exchange had 1,800 stocks the other day. So it's really not that hard to find stocks that are going up. It's just, what is your time frame? But more importantly, can you manage, do you size your positions right? Are you taking too much risk in your account? You have to have, all of the framework laid out, or it's not going to work no matter how good your entries are. Yeah. If you have the best entry system in the world, but your stops are too tight, then it doesn't matter how good your entry is if you get stopped out too early.
Yeah. Okay, well, let's switch over to exits now. Now, we opened up, or we allowed people to submit some questions for the interview today, and a lot of the questions were actually about exits.
Sure.
So why do you think the majority of questions were about exits?
People struggle with exits the most. The two things, and this was the final piece of my system, and I was lucky. I was helped by a gentleman named Tom Basso, who most of your listeners are probably very familiar with. Yep. And the social media world, it's amazing how we're all connected. So Michael Covell and I became friends on Facebook maybe 8 or 9 years ago. I can't remember exactly. And we would talk on Facebook. And then one day I saw that Tom Basso posted on Michael's page, and I recognized Tom from Van Tharp's work. And I just I started a conversation with Tom, and he was very very easy to talk to, and we started to talk a little bit about trading, and there was something that I had struggled with, and what I struggled with was I didn't know how to exit my winners, and as I talk to people now, it seems that the two things that people struggle with the most is number one is over trading, which we've talked about, but number two is they don't know how to manage their winners properly, and for some reason, it seems human psyche that, people will hold on to their losers, for a lot longer than they'll hold on to their winners. And I think a lot of that stems to having no overall strategy. So in my systems, so I follow a 10-step trading program for myself. So I address every aspect of my trade, and everything is predetermined. So my entries, my exits, my position sizing, my risk in the trade, the risk in the account, everything is predetermined. And I think if you don't have a predetermined plan going in, then you're forced to make decisions in the heat of the moment. And anytime you have to make an emotional decision, it's usually a bad decision. But I think people haven't really addressed how they're going to handle their winners. And basically, I manage the winners the same way I manage the rest of the portfolio. Is my winners are based on moving averages. So it's moving averages that'll get me into a trade, and it's moving averages that'll get me out of the trade. So really, all I need, I look at volatility, and I use average true range to size up my accounts. But my entries and my exits are pretty similar to each other. I think the other reason that people struggle, because I get this question a lot, and when I'm on Twitter, and I've got a really nice base of people that follow me, and we have some really good interactions, and I think if once you predetermine what your exit strategy is going to be, it takes the guesswork out of it. But until you find a system that works for you, and I think that's why most people, I think, tend to be shorter term in nature. And when they see that profit, they're scared that it's going to go away. But all I had to do over time was, when I sold my winners too early, is I would go back, one way or another, and look at the chart, 6 months or a year later, and realized how much money I cost myself. And that's when I said, to save myself from myself, let me put all of these rules in writing and get to something. And I'm comfortable with a lot of volatility in my portfolio. So I'm comfortable with watching, some of my winners go up and down quite a bit.
Yeah. So I'm just looking through the questions here on exits, and some of them are really quite specific. So I think maybe before we get to those, you've kind of just touched on it a little bit with the exit, saying that you use moving averages. But can you tell us a little bit more about the philosophy or the strategy behind how you manage your trades?
Yeah, so when you talk about managing the trade, so the first thing obviously is I'm very meticulous on my position sizing. So I know that people talk about different percentages, 1% or 2%. My position sizing is much more conservative. So for my stock positions, I'm going to run anywhere from 25 to 50 basis points per stock position. And what I hold more stocks. I hold about 20 stocks right now, and I've got 4 or 5 ETFs that are spread out. But I found that by having smaller position sizing and keeping my risk in check, I'm not very attached to the outcome of any one stock. So, for example, if you run it at 1%, to me 1% is a lot to risk in a position. But so if you run it at 1 to 2% risk, that's a lot of your portfolio if you get stopped out. And I think that because, if your position sizing is too big, you're going to be very susceptible to changes in your equity in that one position. So that, so I think that the answer with me is that because my position, I'm very comfortable with the risk that I have in my portfolio. And because of that, I'm really not attached to the outcome. I also treat trading, I believe that you've got a 50-50 chance, of being right or wrong. So once I realized that, and I set my stops, like my core program, the 200-day moving average uses a 2 ATR stop. So basically the way that I look at it is I'm going to get a signal. I'm going to risk, 25 to 50 basis points. I'm going to set my stop, and then I'm going to let that go. The problem with exits is I think a lot of people are looking for the perfect, everybody wants big winners, but nobody wants to, sit in for the period of time that it takes. And that's why, I don't use, like trailing ATR stops on my positions. I use an ATR stop when I enter the trade, but I don't use a trailing ATR stop because I found that it cut my positions too short. But for some people, I think that would be the best thing that that they could do, because it's based on what the trader wants to get. Here's what you can do. You can either trade for smaller winners, or you can trade for bigger winners. And the thing is, if you're going to trade for bigger winners, you have to be comfortable having more volatility in that position. There really is no way that I know of to get in at the bottom, get out at the top, and still be in. That's the perfect scenario, but there is no perfect scenario. And I think once people, there is no perfect system. The closest thing to the perfect system is one that you can trade and be comfortable with it. But the simplest thing that I would say as far as how people should manage their exits is, they have to get comfortable letting their winners run. And until in their heads they can get comfortable with letting their winners run, then they're always going to be looked to be taking money off the table. But basically, what my formula is, without giving away too much of it, is the very basics of trend following is the exit signal is simply a reversal of the entry signal. So if I take a trade because it's a daily close over the 200-day moving average, then other than my stop loss at the entry, what the exit signal should be is a close on the other side of the trade below the 200-day. So what I do is I take it a step further and I incorporate the 50-day moving average, but there's a little bit of technicality to it that I don't really get into, in public.
Yep.
Can't give it all away for free.
No, absolutely.
And you guys won't need me on Twitter anymore.
Well, I think you just gave away a lot of awesome advice there for free anyway. So I think people should be happy with that. And
yeah, but what it is at the end of the equation, it's not, the money is not made on the chart. The money is really made in our heads. And it takes a lot of time for people to figure out that there is no perfect answer. Because the way that I manage my trades, if I've got a two-step exit system, and if I didn't use the two-step exit system and I just used the simple, break below the 200-day, on some trades I would make significantly more money, and on other trades I would make significantly less money. But basically, what I did was I put it into a range where I'm comfortable with it.
Yeah. Yep. Now, I'm just scanning through all the exit questions. There's one here that I think you may be alluding to with your two-step exit system here. It was raised by a couple of people. We got Jeffrey and Norm, I think, asked about this one as well. In one of your other podcasts, you reached out to Tom Basso on a stock making a parabolic move.
Right.
How do you manage a move like that now?
Tom taught me about average true range. And the formula that I, with some research, because what Tom basically did, and Tom was really helpful, but, also the fact that I knew Michael Covell beforehand helped a little bit. I don't know that, I want 50,000 people sending Tom an email asking for, I might get in trouble with him, but, because I don't want that. But, so Tom taught me about average true range and volatility. And the one rule that I do use right now, I just took a trade in a uranium stock about a month or a month and a half. And bottom line was, when I set my trade up, I set my risk based on 2 ATR. Well, what happened was ATR, within 30 days, the ATR more than doubled. So now, what I thought was 1 unit of risk, now because ATR doubled became 2 units of risk. So what I had to do was I had to cut my position size in half because I was now taking twice as much risk as I originally intended to. But there is a formula to help people with parabolic moves that says if ATR doubles, that you cut half of your position. So if you start a trade and your ATR is 25 cents, and over the course of time the ATR becomes 50 cents, but that's not surefire either. I will say it's more within a 30-day window. Because if you get into a long-term trade and it starts to work, like some of these stocks like Advanced Micro or Nvidia that have had these really big moves, the ATR is gonna double over time just because the price of the shares has gone up so much. So the ATR doubling over time is not a bad thing. It's when the ATR blows out in a very short period of time that if I'm in a position like I'm with CCJ, which is the uranium stock, if the ATR doubles, I'm going to take half of the position off.
Okay, what about if that volatility goes back to the normal kind of range? Do you get back into the full position size, or do you just leave it?
No, I don't, and I don't micromanage my trades. What my train of thought, and some people, this goes against a lot of things, but my train of thought is the less I trade, the more money I make. And I've experimented over the years with, pyramiding and staggering my entries and what have you. And what I found was that the further that I got away from the initial entry signal, the less effective the method was. So basically what I do is I don't add, very, very often to a position. And if I do, it's after an extended run. So, if I get a signal right now and I decide I'm going to size it up at 50 basis points of risk, I just take the full trade. But, since I'm a private trader, I'm not a mutual fund. I don't have, cash flow coming in every single day where I can just add to those positions. So I found that usually the first trade is the best trade. I may add over time, but it's not anything that I do consistently.
And do you have any kind of limit on the volatility that you'll accept at the entry period?
No, I like volatile stocks, and that's the thing that that's the other thing that people I think struggle with is volatility gets a bad name. Volatility is not bad. Traders usually need volatility to make some money, but more volatile positions do tend to carry a little bit higher risk. So the way that I try to filter out that risk is through position sizing. Yeah. So I take a stock like U.S. Steel and I compare that to a software stock like, let's say, Activision Blizzard. Well, if you use ATR as a formula, U.S. Steel is 4 times as volatile as Activision is. So I'm going to only put 1/4 as much money into U.S. Steel. So I do look for volatility. The way that I look to increase my returns over time is I'm looking to capture, higher beta stocks or higher beta ETFs that are in uptrends, manage my position sizing so that if I'm wrong, it doesn't cost me a lot of money. So volatility is not bad, but you do have to manage the risk that goes with it.
Yeah, okay. And usually, I guess, in a trend-following approach, you can have some heavy drawdowns. So how do you go about trading through the drawdown periods?
When I'm in a prolonged drawdown, I trade smaller, and position sizing, does that automatically, because if you're going to risk, let's say, 50 basis points of your equity, as your equity comes down, the 50 basis points is going to be on a smaller dollar amount. But one of the other ways, and going back to the exits, is, like I said, trend following 101 on that 200-day moving average strategy would only have one exit. And I think that's what allows for some of the volatility because, I look at a stock like Morgan Stanley, which I'm in right now, and I picked it up right around 27 and change, 28. And it's had a pretty big move. And it just broke below the 50-day moving average. So based on my formula, I took off half of the position. Now, some would say that that's not, technically, trend following 101, and that's okay because you have to trade a system that, that you're comfortable with. But I found that by having that 2-step exit system, it has reduced some of the volatility. But when I'm going through a drawdown, I'm naturally going to have smaller positions just based on my account, but my equity being a little bit lower.
What about some of the other challenges of trend following? What do you think that traders typically struggle with when using a trend following approach?
The biggest thing that people struggle with, and this took me some time, is they have to turn their brains off. And it's hard for people to do that. Because when I talk to people, and I've been on Twitter for about 4 years, and I will, constantly say I don't use any fundamental analysis. I don't watch the news. I don't look at earnings reports. I don't look at the Federal Reserve. And then I'll constantly get asked, well, do you look at earnings? And I don't look at any fundamentals. And it's very, very hard, especially traders who have been in the business for a long time. It's very, very hard to just accept that none of that stuff really matters, and that the only thing that determines your profit and loss is the price that's on the screen. And people get overly tied up with indicators. Sometimes I see charts online, and I can't even really understand the chart. There's just so much that's going on. And people, and I think it comes down to prediction. Here's what I know. And I know this for 150% shadow. I mean, I would, bet you my house. I know that nobody can consistently call the markets and can consistently predict the future. I know it. I know it 1,000%. And once you realize that, and you stop trying to find things that are predictive, whether it's on a chart or it's fundamental analysis, and you just let the market do what it's going to, because the market's going to do what it wants to anyway. So you can either fight it, and I mean, let's look over the past couple of years. How many people, just in the U.S. stock market have been calling, it's a top and it's a bubble and it's this and it's that, and this is we're at historic highs, and there have been people who have made no money, and to me that just doesn't work. I'm not here to be right. I'm here to make money, and I think that what most people struggle with trend following is with trend following, all you're trading is the price. And I think that most people just can't psychologically deal with that.
Yeah. Yeah, I might just jump back now to a couple of more listener questions we've got here. Now, here's one from Alex. Alex would like to know, what's the rationale behind the instruments and markets you trade?
It's a good question. My market cap limits. I tend to look for more liquid institutional names. So if you look in my portfolio, I've got Apple and Bank of America and Halliburton, and I've got some pretty big names that are in there. Well, I don't do any fundamental analysis. I just look at where the money is going. So I tend to gravitate towards the higher volume names in any sector. And, that's just what I'm comfortable with. In the small and the mid cap stocks, technically a small cap stock does have more beta, than a mid cap or a large cap stock, all other things being the same. But because I use volatility based position sizing, I wouldn't be able to put as much money into the small cap as I could into the mid cap anyway. So I tend to stick with what I'm comfortable with. And, but I do, with that being said, I do filter out, I use beta as a determining factor. So I tend to filter out the lower beta industries like utilities and consumer staples and real estate trusts. And I go for industries that have a higher beta.
So I think we've got a question here from Neil about entries. Neil asks, how do you measure momentum and what is your look back period?
As far as momentum, in my shorter term program, I do look at, and there is one indicator that I do look at, which is the full stochastic. So in the one program that I trade, if I get a pullback into a rising moving average with a very oversold stochastic, to me over time, it's been a pretty good setup. As far as the break over the key moving averages, really all I need is I don't need the momentum per se. I just need the close over the moving average or the new 52-week high.
Yeah. There's a second part to Neil's question. He would like to know, how often do you rebalance?
I don't really do any rebalancing. So what happens is I don't, I tend to let my positions go and let the exits determine when I get stopped out. But I don't, where I like to exercise discretion is when you first put together the program. So when you put together the rules, you have to put, together rules that you can actually trade the system. But other than that, I don't look at any rebalancing. What I found is that, the markets do the rebalancing for me, based on my exits.
Yeah. Okay, we've got, I think, 2 more questions here in the list.
Okay.
Dan would like to know, do you use limit orders when entering positions after the moving average has been crossed? And if so, how do you determine where to set the limit?
No, I don't. I just, I run the scan at 4 o'clock or, whenever after the market closes. Sometimes I can't look at the market right at 4 o'clock. So I run the scan when I can, if it's 6 o'clock at night. And I've got no problem going into the aftermarket to buy the stock because I trade very liquid names. So if I get a signal for Apple and I need to buy Apple, at 6 o'clock at night, it's fine. If not, I'll just buy it, the next morning at the open.
All right, thank you. And there's a final one here from Brian. What are your thoughts on margin? Do you use margin?
I don't. No, I don't use margin. I generally, the way that I set up my account is I found that personally, I did a lot better when I undertraded in every single way, and just margin wasn't, I don't need to use margin.
Yeah. All right, I think I'm just scanning through. We've got a couple of pages of questions here. I think we've covered pretty much all of those. So I just wanted to say thanks for everyone for submitting those. I think I hope we answered them all for you. Now, just before we wrap up, I'd just like to ask you a little bit about trading psychology. You've kind of shared a couple of insights already with us today, and I know on your Twitter feed you occasionally share some kind of mental insight. So can you just give us a little bit of insight into some of the things that you've discovered over your 20 years of trading?
Oh, sure. And I believe psychology is I don't know what the number is, and we talked before about, the four legs of the table. But the fact of the matter is that trading psychology is the most important because, and I read this in a couple places, but I think it was, it was Jesse Livermore. And that was the most important book that I ever read was, the Reminiscences of a Stock Operator. Because what he said is that, markets don't beat traders, but traders beat themselves. And when I look back over the first 10 years when I struggled and when I lost money, it had absolutely nothing to do with the market and everything to do with, how the decisions I made and how I handled the market. And then I think it was, Alexander Elder who said in his book, that the weakest link in any trading system is always the trader. And it's absolutely the truth. And what turned me from, consistently losing money to consistently making money was just the way that I approach my trading. And, I just approach it with the fact that, I don't know anything. I can't predict any markets. I realize that my system, is slightly better than a 50% win rate. But I know that if I run reasonable stops, so I keep my losers small and I let my winners run, I know that over time I'll make money. But I also realize that if I just didn't beat myself, so I figured out there was about 10 things that a trader can do that can beat themselves. And I figured out if I identified what those 10 things were, and it was mostly over trading and emotional trading, if I could just eliminate those things from my process, that I could probably make money. And so I think at the end of the equation, psychology, if you had to ask me for one thing, is significantly more important than your signals or what moving average that you use or anything else.
Yeah. All right, cool. Thank you very much, Larry. Now, I might just start wrapping up with a few quick closing questions.
Sure.
The first one, what's the biggest lesson you've learned through trading?
That's a good question. I think the biggest lesson that I've learned is over time, you start to find yourself. And what happens is people get into trade, and we both know people all over the world that trade, different personalities, and people get into trading, for different reasons, not just to make money. And I don't always know if people know when they get in, why they're actually getting in. But I think the biggest lesson that I've learned is to really be introspective and be accountable for everything that happened to me. And once I stopped blaming the market or the Federal Reserve or Alan Greenspan, and once I realized that everything that shows you how long I've been trading when I even talk about Alan Greenspan, right? Yeah. But just the fact that if I was going to make it, it was going to be I was going to have to figure it out for myself, and CNBC or a book wasn't going to do it for me.
Yeah, absolutely. All right, next question. What is the best trading advice you ever received?
Now that I look back at it, the best trading advice I ever received, and I posted this on my Twitter a couple times, is that the less that I trade, the more that I make. And my mentor in the business is very close to my family, and he was in the business for 45 years, and he wound up being a high roller with Smith Barney, and he taught me that your trading capital is like a bar of soap. And the more you touch it, the smaller it gets. And it never made sense to me. I posted that on my Twitter a while ago, and I got a good reaction to it, but it didn't make sense to me. But then when I read Livermore, and he basically said the same thing. Once you get into the trade, just sit on your hands and do nothing. So I'd say the best trading advice that I received was to do less and make more money.
Yep. Well said, Larry. Thank you. Now, what do you think is the most important ingredient to becoming a successful trader?
Two things: self-accountability and emotional discipline. So the trader has to accept that everything that happens, good or bad, is because of them, and they have to have the emotional discipline to fight off the things that can kill you in trading.
Yep. Now, you've already mentioned a couple of trading books earlier in our chat today, but what's your favorite trading books?
My favorite, I've probably got four. Number one, obviously, is Jesse Livermore's book, Beyond a Shadow of a Doubt. Michael Covell's book, taught me that I didn't need any price or any prediction or fundamental analysis. Van Tharp, his book, Trade Your Way to Financial Freedom, covers more on psychology and money management. It's an absolute must read. And Market Wizards, the first Market Wizards book where he interviewed Paul Tudor Jones and Bruce Kovner. And, I was, and I don't know if I should say this, but I think I was fortunate that I started, on my journey in the early 90s when there was no Twitter and there were no websites and blogs and all this stuff. So basically the only people that I had to learn from, was books. So, when you sit there and you listen to an interview with Paul Tudor Jones and he tells you how he, what his mindset is, you can learn a lot from that. But those 4 books, if I could only read 4 books, those would be the 4.
Yeah. Great books, all of those ones. Now, what's the best way for listeners to get in touch with you?
Oh, right on Twitter.
Yep.
And my handle is at LMT, which is my initials, LMT 978.
Yeah. Okay, cool. I'll have a link to that on the show notes page as well, if people,
Sure.
So people can find you easily. All right. Well, thank you very much for your time today, Larry. It's been really great chatting to you. Now, is there anything else that you'd like to mention before we finish up?
Yeah, basically, I want to thank you for having me on. Obviously, you've had some very well-known guests, and I consider it an honor to be on. And the, last thing, just like we touched on, I think that, emotional control and under trading is, once traders realize that the answer really is not, the secret chart or the secret indicator, but it's what we do. And I think that gets people on the right path.
Yeah. Awesome. Thank you very much, Larry. You shared a lot of insights with us today, and I think it's going to be very helpful. So, thanks again for spending time with us today, and I wish you all the best.
Andrew, thank you so much. I really appreciate it.
Thanks, Larry. Cheers, mate.
All right. Cheers.
Bye. Okay, so firstly, I'd just like to say a huge thank you to Larry for spending the time to chat with us today. I think there was something in that chat for everyone from beginner to experienced traders, so I'd like to thank Larry for sharing that. Now, if you'd like to get more information on anything that was mentioned in this episode, we also have some additional links to resources and also a copy of the transcript if you'd like to get a written copy of this episode. You can get all that from the show notes page at bettersystemtrader.com/76. You can grab it from there. Also, if you have 30 seconds spare between all the trading that you're doing and you're enjoying the podcast, please show your support by leaving a quick, honest rating and review for the show on iTunes. It's a really huge help in getting the message out there. So anyway, that's it for another session of the Better System Trader podcast. We'll have something more for you next week, so I'll catch you then. Have a great week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.